Hey guys, I wanted to welcome you to Millionaire Brand Creation. I am super excited to have a friend of mine, Matt Willer, in from Denver. And Matt, I'm going to read your bio. So I'm going to extol your accomplishments a little bit here before we begin. But Matt's a graduate of the University of Southern California, Marshall School of Business, actually a school I got waitlisted from with an emphasis in finance and management. And then Matt began his career as an investment banker. And then he worked for Smith and Barney in the 1990s, been a lifelong student of capital markets, has been involved in over 100 debt and equity financing raises with a dozen M&A transactions on both buy and sell sides. And he has raised in excess of over $3 billion in debt and equity capital during his career. So thank you for taking the time, Matt, because this is something that is very, I think, pertinent in today's time about raising capital, raising money, doing business. And if you could begin us in your journey when you were a little kid, what gave you that financial background? What gave you that business acumen?
Actually, Michael, you might not even know this, but there was a very specific event, and it dovetails into my intro a teeny bit. So, my admission into USC, pursuant to your being waitlisted, wasn't because I was necessarily any more qualified on paper. It was because my grandfather, Don Willer, who you can Google, was the captain of the 1942 USC Trojan football team. So, turns
Ah,
out when you have blood lineage that is the star of a football team and all American player, then you get different treatment. Now that's not true anymore. But I but I digress. It is that same gentleman, Don Willer, who was an avid real estate investor, gave me kind of my first foray as a child, by the way, a young child into investing in general. And for my sixth birthday, he gave me a physical certificate of General Motors preferred stock. Now, not dating myself, but that was radically prior to the internet. So, how do you observe stock prices? Well, that meant the Wall Street Journal or the Sunday Los Angeles Times, where I was raised in Southern California. And that's when things were still quoted in eighths and quarters and halves, no decimals. And I was fascinated. It gave me something to watch, it gave me something to research, it gave me something to think about. And it was just those young ages that stuck with me. I always knew that I wanted to be in and around finance. So the rest is history, I guess, now over 40 years later.
no, it's fascinating. And it's a language of sorts, right? You have to learn the language of money. And tell us a little bit about how you got into investment banking and then the transition into what you're doing now.
Sure. Well, I'll be as transparent as I was previously with this matter. So when you're really young, as you start to think about college or a career, et cetera, if you have finance or even business in general in mind, you'll hear kind of buzzwords from other people that are pursuing a similar career or friends and family members that investment bankers make a whole lot of money. All right. And so that's the intrigue as a 16-year-old. Okay. Now, as you mature and you go through whatever form of education, whether that's formal or the school of hard knocks, you recognize that quote unquote being an investment banker is maybe a cool title that a lot of people don't even really know what it means. But really, what it is you can apply the skill set to anything thereafter in life because everything requires capital. And an investment banker, in summary, is simply the connection of capital and the need for capital. That's it, right? And so that doesn't just apply to being an investment banker at Smith Barney or being a principal or partner at Goldman Sachs, et cetera. It's a skill set, it's an expertise that is far larger, substantially larger than just the markets, right? We think about stocks, IPOs, et cetera. I know you have a lot of real estate exposure. It all requires capital. And so that's really the cornerstone of what my career has been. But originally, what drove me to it was money.
Hmm. Well, at least you're honest. I mean, that's what drives us to it at the beginning.
Yeah,
and and here,
it's not to say that I'm cavalier or greedy or dishonest. I mean, those are mutually exclusive terms. I'm a Christian and I'm a conservative and I'm a capitalist. So my values are strong, but my desire to have my time be well utilized and well compensated is something that is important to me and my family.
and that's the biggest question I think that reigns. A lot of people that watch this are entrepreneurs and or in the real estate space, real estate agents, etc. People that are maybe hitting the reset button in their life. Maybe they're struggling to make a sale or to do a deal or what have you, and they're looking for encouragement and or direction as to what they can and should be doing. The thing I always ask is, you understand capital markets well, and if you had to educate your kids, because you have three of them, if I'm not mistaken, right, or four?
I've got three.
Great.
That's
So
plenty.
if you had to educate them on the basics of finance as you grow and as you have probably a 40-year time span in the workforce, what are some of the moves? What are some of the investments? What are some of the things people should be doing to create a better future for them and their family?
I think it all candidly starts with discipline, because the earlier you start with some sort of plan, even if it's modest, you can't make up for time in this life. Okay. And so, specifically with my kids, what I did is I showed them how just getting on a schedule of contributions into, say, a Roth IRA, even if it seems negligible at age 18, I ran them illustrations to showing them what $100 a month for the rest of their life until they're forced to take out withdrawals at age 73, what that looked like. And all three of the kids were shocked to find that they'd be millionaires. Now, when you run an unemotional math equation, which I'll call an illustration, then it gets people excited because that's the finish line, right? And you define that finish line, but you got to start somewhere. And so it's real easy, especially in your teens, your 20s, you're finally making a few bucks, and you're more apt to go to a bar or a nice restaurant and blow 100, 200 in this day and age, 3 to 500 or more, than do something as simple as just putting it away. And when you're 60 or 70, you're going to look back and say, I don't remember what I had that night to eat, but what I do remember is my balance at Vanguard is $7.2 million. So it's that from day one, that cornerstone of a plan, of discipline, of just this compartmentalizing things. That's kind of the hardwire of the psyche of the individual. And then from there, the question is, how am I deploying this capital? How am I investing it, and why? Now that opens a bit more of a Pandora's box because we have different asset classes, different tax considerations, et cetera. But that can be navigated through, and candidly, Michael, might change as you age.
Yeah.
Right?
And the thing, it's understanding risk versus reward and understanding cash flows. Because the thing that I always run up against, and I know a lot of people in the real estate business do, is we may be asset rich, but we have real spotty cash flows.
Mhm.
And I think in the sales business, it almost, happens that way, right? It's feast or famine. And now with interest rates ticking up, and in the near future they continue to move up, it tightens a lot of people's households. What do you do in that type of time, what are some of your recommendations?
Well, that's all. That kind of maybe dovetails into diversification of your overall kind of net worth and portfolio. Now, someone that's in the real estate market, especially on the sales side, where it's kind of a feast or famine commission based situation, the goal there would be that the days that are feast, the months where you close a big deal, that you're maybe diversifying some of that outside of real estate. Because I know we all get passionate and maybe even blinders on about the asset class that we're in and we know so well. Like my grandfather was a real estate guy, and you could not talk him out of it. And you know what, he did great. So I don't have any issue to make of that, other than it would be nice to have some pockets of liquidity outside of, say, just that one lane of real estate when you're in a earning capacity that can be seasonal, can be impacted by macro and microeconomic situations, which real estate and interest rates are obviously quite correlated. So I think having some diversification, and that's just a broader concept that everyone benefits from anyways, not having over concentration, and especially as we age, again, back to that point, I could take shots when I'm 20, 30, 40 all day long. And if I lose, so be it, because I can make it back. If I
Right.
win, it's going to be a big payday. But I'm
Right.
not doing that at 50.
Right.
I'm de-risking my own portfolio, and I have plenty of earning years left. But that's just kind of the natural progression. So I think diversification, being thoughtful about having some assets that are not correlated to the same variables that are impacting real estate is important. For instance, in my personal portfolio, I've got assets that are completely independent of interest rates altogether. I have non-market correlated assets, et cetera, so that I know when one thing is ebbing, another thing might be flowing, and in a more of a basket of asset approach, I'm never really in a dry period per se.
No, that's a good point. And I think young people, I think, are afraid of it, right? Because you have this flex culture. You have this idea that everyone wants to look rich, but in reality, behind the scenes, they're not. And that's the scary component of actually growing your net worth and growing your future. Can you talk a little bit about your story and how you transitioned to where you are today before we kind of jump into the capital raises that you've done and things like that?
Yeah. So as you mentioned, I cut my teeth at Smith Barney, which is now a division of Morgan Stanley. So it's in that same category: Morgan, Merrill, Goldman. The top tier investment banks where you're raising capital. Now, when I came out of school, it was right in the crux of the lead up and then the fall off of what we call dot bomb. It's now .com 1.0, right? At the
Right.
time, it's funny because of my timing. So I came out of USC Business School with a degree in finance, and every single thing I'd been taught in the last 4 years flew out the window in .com, right? Fundamental analysis, valuation. It's like all of a sudden, if you have a .com at the end of your name, you're immediately worth at least $1 billion. Oh, you don't have any revenue, right? Oh, the business hasn't even exist yet, but you have the domain. Well, heck, why not $1 billion? So that was challenging for me. But of course, I'm the smallest fish in the big Smith Barney pond. So I'm not knocking on Sandy Weil's door, who was the CEO of Travelers, which was the parent company, and he doesn't care about my opinion. So you do the deals, right? But the point being is Smith Barney created a very, very healthy foundation and education of street smart and commercial reality and Wall Street type of situation vis-a-vis classroom education. And there was a lot of overlap. Don't get me wrong, but capitalism is what the market is willing to bear, and it wasn't all based on fundamentals. So that gave me the foundation, the education, the understanding of quote unquote the first step into the real world. And from there, I had things I liked and didn't like about where I was positioned. What I didn't like is I personally don't operate at full efficiency in a company with 100,000 employees. Okay, that's just not, I'm not a big company guy. I like to have more input, control, not control like I'm overbearing, input, thought, and maybe creative assistance on deal structure and things like that. Something that's never going to be accomplished, at least at that age, at that big of a firm. Not uncommon is sort of there's three paths when you start out as a junior investment banker. There is the burnout because you work 120 hours a week, and some people say I can't do it. The next path is the lifers that are just going to say, all right, I'm going to Smith Barney's my firm. I'm going to work my way up the food chain, and one day I'll be a partner or a managing director or what have you. And the third path, which is quite common as well, is I'm going to go into the same line of work with a smaller firm. And a smaller firm is the ability to be more agile, certainly make more money, have some input on deal flow, maybe pick and choose the types of deals that you really want to participate in, on and on. So that was the progression of my career. Smith Barney is where I cut my teeth. And then from there, I went to smaller firms. I had my own firm for quite some time. And then I've where I am now, which we can get into if you like.
Yeah.
Where I am now, this is my third iteration of being with what's called the issuer. And so rather than investment banking, where you're on the other side of the table and you are just kind of transactional in nature, I might work 3 to 6 months on a $100 million transaction in a biotech, and then I'm on to the next file. Whereas when you're with the issuer, now you are working for the company that's raising the capital in the investment banking function. And that's naturally how we met, Michael, in terms of our relationship. And I have a lot of fun with that. And candidly, from a professional only perspective, where I am now will very likely be the last job that I have because I'm engaged. I've got a lot of personal capital and exposure. I have a great investor base, et cetera. So there's not a high degree of interest at my age of going back into the purely transactional side of the business.
Can you tell us a little bit about how you got involved with, I mean, I don't know if we can talk about the company and all, but how you got involved with PHX and how you actually scaled it up from zero, because that to me is so fascinating.
Love to, because it's been a lot of fun, and looking back on it is easier than it was when we were looking forward into the wind on day one. PHX Capital Group, for those of those that are going to end up joining this podcast, is a domestic energy company, completely private. All right, so it's myself and 10 partners that are the equity owners, and then we have 100 full-time employees. When I was introduced to the firm, I had my own firm. Okay, so I was raising capital. It was on the heels of kind of me coming out of a big engagement, and I just wanted a little bit time off is really what I was looking for. So I made my own schedule, but I did some deals with my own shingle. I was introduced to Phoenix when they were looking to raise capital. Okay, now this was the very nascent stages of the company. They were a startup, and I got to look at the business plan, the software, the industry, the people, and all of it checked my boxes. And so what I did is I said, and I didn't have prior relationships with the founders, so it wasn't like we had any. I was being a little bit presumptuous in some of my comments and thoughts. What I said to them was, folks, I can raise you the money, and I'll be happy to take 5 or 7% commission, which is the going rate on an outsider raising capital. But I'm viewing a company that's likely going to have a long upswing of growth that's going to need to raise capital in perpetuity, not just once this year and we're done. Some companies, some industries, that'd be suitable. Maybe you need a technology iteration that's going to get you to patent, and then cash flows from operations will take you from there. If it's software, it happens. But in an operating entity that's capital intensive, you're going to have that need as you grow. So is your need for capital, even though you're very profitable, because all it means is you're growing faster than your cash flow coming in. It's not a bad thing. And so they agreed. They said, yeah, absolutely. Like if this goes as planned, then yes, we will need and want access to capital in perpetuity. And I said, well, do you want to pay 5 to 7% every single year for the rest of your life? Or does it make sense to build a division in-house, one that I'd be happy to spearhead? We cut out me, as in the middleman, and I'd be willing to do this and have some skin in the game, right? Give me some equity in the organization. Forget the fee side of the equation. Long story long, they agreed. Now, from there was a little bit of discussion, let's say, about how we were going to go about this, because I came from a very conventional background, right? We've approached institutions, big check writers, et cetera. And they said, well, absolutely, there's going to be a piece for that. But we're really thinking in this day and age that we can raise the capital from investors that are looking for alternatives. And I said, I don't know the viability, but I do agree that investors are looking for alternatives. And if you kind of reflect back, if your audience walks down memory lane and goes back to say 2020, 2021, coming out of COVID, we've been in a zero interest rate environment forever. You guys in real estate know it better than anyone else. It was great for borrowers. It was terrible for fixed income investors and those that are saving and those that are retired. But then when we kind of got into the discussion of, are we inflation out of control? Are we potentially going to need to lift interest rates? Is that going to put us into a recession? All of these things. Yeah, you still had a zero interest rate environment at the time. You also had a very, very, very volatile stock market. So the viability of how we approach this raise was not fully our own doing. We have some tailwinds that I have to just transparently address. When no one can make any money in a bank and people are getting killed in the S&P 500, more people look for alternatives. So that's the nexus of how this started. We agreed there are enough individuals out there, some with very high net worths, that say, you know what, I'm a little uncomfortable having all my eggs in the market basket because of the volatility. But come hell or high water, I'm not happy with 3 or 4 or 5% in the bank, which is higher than what it was 2 years ago, right? So we kind of service that audience. You know that because you're an investor. I know that because I'm an investor and a principal with the firm. I didn't know the magnitude of what would happen. So this goes back 3.5, 4 years at this point. And in those nascent stages, it was just as new to us as it was to the audience. And so it wasn't polished. We were trying things out. We knew what we did. We knew what we wanted to convey. But, like any first go around, we were tweaking the message. What are people receiving? Is this too complex the way I'm presenting it?
Right.
And we finally, over time, like anything else, got to a message that wasn't so oversimplified that, sophisticated investors would be turned off, but wasn't so complex that a retired school teacher is saying, Matt, I have no idea what you just said. Because our goal is, and I'm not being disparaging in any way, shape, or form, like we're trying to be detail-oriented and comprehensive, but to a very large audience. So we probably raised a couple $1 million in those first 4 or 5 months. And it was nice. It was exciting. There was some good feedback and met some great investors. And then from there, really rubber met road. And so now when we look back, I have the June 30th numbers just 8 weeks ago, and you'll hear these next week if you join our investor only presentation. But we're now, after that period of time, we've raised over $300 million this way. Okay,
Crazy.
Direct to people like you and me, my friends and family, my people I've never met in Maine and Massachusetts and Florida. And the reason is this: we're honest, we're transparent, we have a good business, and we have a good investment product. And not a lot of things have all of those.
True.
It might be a little speculative. It's too early stage. Maybe the returns aren't what I'm looking for. Maybe you're not comfortable with the industry. Maybe the people within the organization don't feel like that my gut tells me those aren't partners I want. But when you have the whole package together, now it's really just conveying it in a way that people believe you and people understand that this is what it is, right? This is not nonsense. This is not BS, because that can be challenging to navigate for people that are on Facebook and Instagram. The second you click that you're interested in investing, trust me, you know this. You'll see 10,000 ads from 10,000 different opportunities, and it could be overwhelming. For us, it's been an interesting journey. I got there by way of my background, And then 4 years later, we've built effectively what we've done, Michael, is we built an investment bank within an operating company.
Yeah, how did you
So
go about doing that? I mean, did you do it via Facebook and Instagram primarily, or was there a different platform for which you began?
very nascent stages before there was any actual investment, there's naturally a considerable amount of legal and accounting and regulatory work before you could become an issuer. So that was step one. Once we were in a position with approved files, we can issue securities. We've got the blessing from FINRA and the SEC. Then the first iteration, I'll be candid, was word of mouth and people I'd done business with before. And
Mm,
the reason is that it was a little bit of a flyer. If you take yourself back to 2019, 2020, this is a bond for the audience. You don't know that yet, but this is not a stock investment. It's a bond investment, meaning it's a corporate obligation, just like a mortgage in the real estate industry. We're borrowing money from our investors. We're paying them a reasonable rate of return, and we owe them the money at the end. So put yourself in that position. We're a brand new company, and you're presented with a bond offering with no track record, not the least of which is
tough
we're in the
though.
energy space. So no one would have taken that deal on its own. And so I went to people that knew me, had good experiences with me in the past, just like any of your audience could do, relationships, trust, rapport. And I went to those folks, and that was the first round of what we call passing the hat in this business. All right. I'm going to check. I'm going friends and family and colleagues and Denver people. Matt Willer, in your presence, is writing a check personally. So I'm in. You in? Okay. It's that deal. And then that got us the first amount of capital to really take the next step outside of our own personal capital that we put in. And then from there, we started to have track record, history, profitability. We could share this with strangers. And so that part of it's really been going on for about 2.5 to 3 years. At that point, here's the way that we reached people. The most cost effective
Yeah,
has
please.
been social media. So it, surprisingly enough, is Facebook and Instagram and those types of vehicles. Once there's a little bit more awareness about you, then we kind of bolted on search. So, kind of the paid search in Google. And we also now do some print and podcast and radio advertising as well.
How much does something like that cost on a daily basis when you am it out over the year?
Well, it's really gonna like your spend is gonna be kind of defined by you, right? And so we will ratchet it up or back it off based on the capital that we're looking to raise in a certain period of time. Give you by way of an example, Curtis Allen, you may recognize that name, but he's my partner and CFO. We have a meeting every Monday, and in that meeting, our team presents. Here's the deals that we have under contract over the next 30 to 45 days, and that last week was like $61 million. So then we take our cash flow from operations that we'll be reinvesting ourselves right into that, and then there's a difference, and that difference, that delta, that's what I'm in charge of raising. So if that's a huge number, because we've made some really big commitments, then we might amp up the spend. I'm going to do more presentations or webinars. We will raise more money. The other situation happens too. Last year, come the end of October, we had closed our biggest deal. Now you're ending the holidays. We don't need money. We're going to cut it off, right? So you can ebb and flow. Now, what I don't want to, I got to be sensitive a little bit to
Sure.
information that I'm not, going to share in the public domain. But it's reasonable to assume that you can attract capital efficiently for about 5% of the capital raised or less.
Mm.
So, point being, if I get $100,000 of investment, it's conceivable that all the ads and the overhead of everything that put that together, the marketing firm, the whole enchilada, you would expect, at least based on our experience, our industry, our offering, you could expect that 100,000 to cost you between $2,500 and $5,000. We've seen it lower than that, but that's generally it. So put you kind of back into the math, right? If we're trying to raise $10 million in a month, then it could be up to $500,000. But I'll say this, it's way better at the end of the day because that cost is somewhat lateral to hiring Morgan Stanley, et cetera. But we also have our obligations really spread out because Michael might have $200,000 in a 7-year bond and Bob has 100 grand in the 9-month. They started at different times as it is, and another person has a 3-year and they started. So it spreads out our liabilities. So we don't have some bullet payment due on like a 5-in-1 arm
Right,
that,
right.
that we would with a bank or we would with an institutional round that has a defined end date, right? So we say, okay, listen, we don't have a single month where our redemptions at maturity are over $5 million, our cash flow from operations is in excess of $10 million a month. So by spreading it out, now we don't have to think about refinancing in a bad market. We can pay people back still just with cash flow from operations and still be cash flow positive. So it's, even though the cost is probably comparable to a conventional raise, sometimes better, sometimes mildly worse, the net of it as a benefit, at least to our type of company, is far more valuable. And then
Mhm.
two, you have a sticky audience of folks just like yourself and myself and my family members that say, you know what, maybe on day one I was a little apprehensive, but now I'm a year or two into it, and these guys did exactly what they said. You know what, I'm going to tell a friend, I'm going to tell a family member, a neighbor, or my podcast constituents, legitimate word of mouth. You know it from your industry. There's nothing more valuable. So for us, those new investments have no cost of acquisition. There is no 5%. That doesn't exist when I sell $100 million worth of bonds to the CalPERS organization.
Oh, that's brilliant. Now, if you had to do a takeaway, if you had to do a takeaway based on, let's say you had to give one piece of advice to your kids, what do you think it would be and why for their futures and their success?
First of all, start with something you actually are passionate about and care about, because you will always be better at something than you care about, even if you could make more money somewhere else. And so for me, I found that in a weird way, as we started this presentation off with, I found it in a weird way, but I didn't know exactly what that meant at age 6. Let's be honest about this. But I knew I was fascinated. I knew that I could be passionate about this. And so I've devoted my professional life to that, even my schooling to that. And so I come off very confident. I'm well versed. There's not a single question that even Warren Buffett could pose to me as it pertains to finance that I can't answer without hesitation. So if you're an expert in your trade and you're passionate, and that will by osmosis be conveyed to whoever your audience is. And it's, you can't have it be bogus or bullshit, excuse me the language, but people will see through that. Well, when you're legitimately that into something, and you've spent a lot of time, energy, and passion devoted, then you will be the best of the best, or one of the best of the best in that position. And I think anyone in any industry can do very, very well if they're one of the best at it.
Yeah, no, that's great. That's great advice. Is there a quote or something that resonates with you that you could leave us with the audience?
Yeah, but I'm not sure it's the direction you necessarily wanted to go. It's hanging on my wall in my office, and it happens to come from my favorite president, Ronald Reagan. And it's something about the 9 words that you never want to hear, and it says, I'm with the government, and I'm here to help." So,
Yeah, ain't that the
so
truth?
I've always been, a conservative and a capitalist, and I take no issue with people on the other side of the aisle. I've just always been of the mindset, as partially a product of my upbringing, that people tend to do better things with their money than the government. And that is not a selfish comment. I observed my dad's company. He was a CFO at a crane company in Southern California. When he started there were probably 200 employees, and it was a 10 to $20 million a year business. When he retired 40 years later, they were almost $500 million a year and 3,500 employees. That's trickle down economics. That's capitalism. Put that same amount into the tax system and try to find 3,500 jobs that came of it, all well paid, all loyal. I use that Ronald Reagan quote kind of facetiously because it's cute or it's funny, but I believe it, right? I do feel like money in the system is efficiently put in good places. That means more employment, more earnings, more businesses that can open. And so I really like just kind of general capitalism. I've always been a student of it, and I've certainly been in and around it as a career.
Oh, I love it. Love it. And Matt, what about the non-accredited investors? If they
Yeah.
wanted to ever jump in, when do you think the next offering is going to be?
You know what? That's such a good question. It'll be very soon. I would go on record and say I believe it to be in the next 30 days. Here's for those of
Right.
that don't know the process. Everything is heavily regulated when you're issuing securities. Certain offerings require a certain net worth or income. That's an accredited investor. Everyone else by default is not accredited. It's an outdated term. But one of our offerings that is open to everyone was very popular because 88% of this country is not accredited. Well, we feel very strongly about having an offering for everyone, but it was so popular, it got fully subscribed. It hit the limit. So when you do that, you submit your paperwork back to the SEC. We then reopen it, but there's back and forth to update info. So we're at the last of that back and forth. Usually you have 30 days on the clock at that point. So that was last week.
That's
So
great.
sometimes it could be 2 weeks, could be 3 weeks, could be 4 weeks, could be 2 days.
So if anyone in the audience wanted to follow you or get to know you better, or interact with you in any way,
Yeah.
what's the best way to get in contact with you, Matt?
Sure. So the company is PHX Capital Group Holdings LLC. Now, for candor, there are other companies that have very similar names that are unrelated to us. So please don't confuse our firm with someone in the hotel industry or the freight factoring industry. We are in the energy space. So I would go to phxcapitalgroup.com. And then on the contact us page, there's 4 different offices. You can call any of those offices and reach me. You can also click on the About Us page and find my bio and ways to contact me directly. And I'd be happy to talk in general. It doesn't have to be about the investment with Phoenix. If you have questions, I can be any sort of resource from a general finance perspective. I talk to people all the time. I work long and late hours, and it doesn't all have to be about corporate bonds at PHX Capital Group. I welcome discussions with anyone that I can be helpful to.
I really appreciate your time, Matt. And I might have to call you myself to get some financial acumen, because I'm too heavy. I'm too heavy in real estate. And now I'm building a house and it's just eating me alive. And I think it's interesting because I love rental income. I love continual income. And I think what you have to offer is a great alternative for a lot of people.
It's a way to augment what you're already doing. It's another form of cash flow, not all in the same capital stack or industry vertical. So back to that diversification point. But Michael, we talk here and there, so you call me anytime.
I appreciate it. Well, thanks for the time, Matt. I really
Yeah,
appreciate you. Have a great
absolutely.
day.
Of
Thank you
course, you
so
too.
much.
Thanks for the
All right.
invitation, Michael. All right, take
Bye
care.
bye.